Welcome to Man Does Tech, where I solve the problems you didn't even know you had.
In this video, I will explain how to use gamma exposure. Gamma exposure is a crucial concept in options trading, representing the rate at which an option's delta changes for every 1-point move in the underlying asset's price. Understanding this metric helps traders anticipate market maker behavior and potential price movements. It's a second-order derivative of the option price, offering deeper insight than delta alone. Market makers who facilitate options trading constantly manage their risk by hedging their positions. Their collective gamma exposure significantly impacts market dynamics. When dealers hold positive gamma, they tend to buy into dips and sell into rallies, which can stabilize prices. Conversely, with negative gamma, they might sell into dips and buy into rallies, potentially accelerating price trends and increasing volatility. A critical concept is the gamma flip, which marks the price level where the overall market maker gamma shifts from positive to negative or vice versa. This level often acts as a significant pivot point for market behavior. When the underlying asset trades below the gamma flip, market makers might need to sell into strength and buy into weakness, potentially increasing volatility. Above it, they may stabilize prices. For individual traders, understanding gamma exposure can provide a significant edge. You can use identified gamma levels as potential areas of support or resistance, especially around strikes with high open interest. Monitoring the overall market gamma can help you anticipate whether the market is likely to be range-bound or prone to trending. This insight allows for more informed decisions regarding your trading strategies.
Thanks for watching. If you found this helpful, don't forget to like and subscribe.